Welcome to our first chapter, 10 Principles of Economics. So first, the purpose of this class is to provide you with the tools that can make your assessments about our whole economy. So for example, we hope you can discover how the world works. And then the second purpose is to help you to become an informed citizen. So for example, these days we know government will have different physical policies or monetary policies. After learning economics, I hope you can understand how these policies can affect our personal life, our daily life. Okay? You might see a little bit weird why I always look at this way, right? Because my monitor was set up at this direction. And the first chapter is talking about 10 principles of microeconomics. In this chapter, we might focusing on five foundations, okay, not all the 10 principles. So in this question, we try to find the answers for the follow-up questions. The first one will be, what kinds of questions does economics address? Second question will be, what are the principles of how people make decisions? And then the last question will be, what are the principles of how people interact? Okay, so there are the three questions we try to find the answers in this question. Hello, Econ 201 students. Welcome to our first chapter, 10 Principles of Economics. So the purpose of this class actually would like to help you to make your own assessments about our whole economy. Hello, Econ 201 students. Welcome to our first chapter, 10 Principles of Economics. So the purpose of this class actually would like you to make your own assessments about the whole economy. And you might feel a little bit confused why I always look at in this direction, right? Because my monitor is at this direction. And I only can watch my lecture slide through this directions. Okay, so you might be feel a little bit confused why instructors or why teacher you always look at this direction. So first, we would like to help you to discover how the world works, okay? And then for the second purpose of this class, we hope you can become an informed citizen. So hello, Econ 201 students. Welcome to our first chapter, 10 Principles of Economics. So the purpose of this class actually is help you to make your own assessments about the economics. And then we hope you can discover how the world works. And I also hope you can become an informed citizen. So these days we might notice there are different type of their physical policies or monetary policies that comes out. And after you learn economics, we hope you can understand why these policies and how these policies will affect our daily life. You might feel a little bit confused why I always look at in this direction, right? Because my monitor is at this direction. Okay? So our first chapter focusing on 10 principles of economics. And in this chapter, we actually need to find answers for those three questions. The first one could be, what other questions does economy address? The second question would be, what are the principles of how people make decisions? And then the last one will be, what are the principles of how people interact? Okay, so these are the three questions we try to find the answers in this chapter. Now let's look at two different concepts, okay? Which one do you prefer? Okay, I will give you two options and then you might tell me which one will you prefer. The first one could be, would you prefer $10 or $200? If for me, I would prefer $200, and I bet the majority of you will choose $200, right? And then for the storage space, for the disk space, would you prefer 2 GB or 1 TB? So 1 TB equal 1024 GB. Which one would you prefer? 2 GB or like 1 TB? So for me, I would prefer 1 TB because it can help me to put more materials into the storage, right? Into my USB drive. So the idea here is you can just look at, well, I just give you the two examples, okay? So the idea here is we always say that more is preferred to less. More is preferred to less. So this leads to unlimited wants. I always prefer more money. I always prefer maybe more housing, more facilities, right? Maybe more leisure times. So we were generally never say no to having more, okay? But that doesn't mean that we are greedy. Here, more is preferred to less. We only referring to more goods. So for spiders, we know in Oregon we have a lot of spiders, right? But for spiders, I prefer less to more. For the ants, these days there are a lot of ants appears around my house, so I'm feel a little bit scared. So for those bad things, we prefer less to more. However, here more is preferred less regarding to goods. Okay? So we notice that people, human beings, tend to have unlimited wants because we always prefer goods more to less, right? However, our society's resources are limited. This is what we call scarcity. Okay, so scarcity means the limited nature of society's resources. So you can see there are some contradiction. People has nearly unlimited wants, right? However, our society's resources are limited, right? Or we have limited resources. You can see how can people allocate those limited resources to satisfy their unlimited wants? And this is how people make decisions. Okay. Remember that scarcity doesn't mean that poverty. Okay. Therefore, as I just mentioned, we have unlimited wants, but resources is limited. So how do people allocate their limited resources to satisfy their unlimited wants? And this is why we have to learn economics. Because economics is the study of how people allocate their limited resources to satisfy their nearly unlimited wants. And economics is also the study of how people make decisions. In this chapter, although we will have 10 principles, right? But I will focus on five major foundations. Five major foundations. The first one we would like to talk about life is about trade-offs. For the second foundations, I would like to introduce opportunity cost. So opportunity cost is one of the most important concepts in this chapter, okay? Opportunity cost. Then we'll move on to marginal thinking, the third foundations. In the fourth foundations, we would like to talk about incentives. And then the last one, we will talk about trade creates value. Okay, so those are the five foundations in this chapter we will learn. Now let's begin with the first one. Life is about trade-offs. So we would like to say all decision here involves trade-offs. Okay, It's a little bit hard for me to erase to wipe those markers. Okay, so all decisions involve trade-offs. I will give you some examples. First one, going to the movie theater. Okay, you might want to choose which movie would I watch. Okay, should I watch either the action movie or like the romantic comedy? Because at the same time, you can only watch one movie, right? So this could be one some decisions you need to make. If you choose to watch a action movie, you might need to give up the romantic comedy at the same time, right? And you might also make the decision, okay, where to eat to celebrate your birthday. Do I eat in a famous Dave's or maybe Texas Roadhouse? Okay, so at the same time, I mean, maybe in the morning, but you can say, okay, in the morning, I would like to celebrate my birthday in famous Dave's, and then in the afternoon, I can celebrate my birthday in the Texas Roadhouse. This is not a case that we talk about, okay? We talk about just maybe in the morning, where would you eat to celebrate your birthday? Okay, either famous Dave's or Texas Roadhouse, okay? Or there is another question. After high school, do I still continue to study? Maybe going to get my higher degree? Or do I need to go to a full time job first? So those are some decisions people might face, right? And every decisions here involve trade-offs. For the second principle we would like to learn is opportunity cost. So first, we would like to say making decisions require comparing the cost and benefits of different decisions, right? Different choices. The opportunity cost is whatever must be given up to obtain the item. Okay, so this is very important. This is the definition of opportunity cost. We would like to say the opportunity cost of any item is what you need to give up to obtain the item. So we would like to say this is also the relevant cost of decision making. First, let's go back to the trade off that people might face. After high school, do I need to go to work, find a full time job, or continue my studies? First, we would like to say the opportunity cost of going to college for 1 year is not just the tuitions, the books, the fees that you need to pay out of your pocket, but also the forego wages, right? If you choose to study in a college, you might give up the money that you can earn for that year, right? However, if you choose to work instead of going to college, then the opportunity cost might be the higher income in the future and other non-monetary benefits such as working experience. Okay, so you can see the opportunity cost of any item is what you need to give up to obtain the item. This is the definition. So let us just do an example, okay, to have more understanding about opportunity cost. Here is the example. Consider Mandy's decision to go to college, okay? If she goes to college, she will spend $20,000 on tuition, $10,000 on room and board, and $2,000 on books. If she doesn't go to college, okay, she will earn $18,000 working in a store, okay, and then she still need to pay $8,000 on board and room. What about the Mandy's total cost of going to college? Okay, there are four options. So when you encounter this type of the questions, how can you solve? After learning opportunity cost, Then the total cost will including two parts. So the first part is what we call a visible cost. Okay. The visible costs are the costs that you need to pay out of your pocket. So for example, the tuition, right? If she decided to go to college, she need to pay tuitions, right? So the tuition will be $20,000. That's from tuition, right? She need to pay the book fees for 2,000 dollars, okay? And then the extra part will comes from the room, or we call the rents. So this part will be $10,000. Okay? So those are the visible costs that Mandy need to pay out of her pocket, right? But if she decided to go to college, she also give up maybe 1 year wages she might earn, right? So here we have the wages that she could earn for that year. And that wages, according to this question, will be $18,000. However, if she choose to work, she still need to pay the rent, right? So here we have the rent, or what we said, the room and the boarding fee would be $8,000. Okay, so that will be the rent. So from this part, even she could earn the wages, right? But she still need to pay the rent. So from this part, we can compute the net earning. And the net earning will equal $18,000 subtract $8,000, right? And this part will equal $10,000, okay? So $10,000 is the opportunity cost here. This $10,000 here is the opportunity cost of going to college. This part will be the opportunity cost of going to college. Now, this question asks the total cost of going to college, right? So the total cost of going to college actually including two parts. One is the visible cost that she need to pay out of her pocket, right? And then she also need to consider if she decided to choose going to college, this will be the things that she need to give up, right? $10,000. Therefore, the total cost now including two parts, visible cost plus opportunity cost. Okay? So what's the answer? You just need to sum those numbers, right? Those are the cost out of Mandy's pocket and the opportunity cost. Okay, so totally you add those four numbers together. You add these two numbers and then those numbers together, you can get the answer finally will equal total cost here will equal $42,000. Okay, so the answer could be option B. Understand? So this is the way that we compute for the total cost. So after you're learning opportunity cost, don't forget to add this opportunity cost. Okay, it is very important. Now we assume that people are rational in economics. When we learn economics, we assume people are rational. So why people will be rational? We assume that people were systematically and purposely, okay, to do the things that can best achieve their objectives. So for example, The objective of a company is to maximize what? Company will always try to maximize their profits, right? And then they will try to minimize the cost, right? So this is what we assume in economics as well. We assume that people will also try to maximize their profits and minimize the cost. Therefore, when people make decisions, we will always choose the decisions with the lowest cost. Okay? So for firm, try to maximize profit and minimize cost. So this one we try to maximize, and the cost we hope we can have minimized cost. So how people make decisions in our daily life? That could be our second question, right? First, we need to determine how many options we have, okay? And then we need to determine each option's cost, including the opportunity cost, okay? At the end, the rational individual or the rational human being, they will choose the options with the lowest opportunity cost. Okay, choose the options with the lowest opportunity cost. So it might have this type of the discussion. Is college is for suitable for everybody? Is college suitable for everybody? How about for professional basketball players? We know that LeBron James, he did not attend any colleges or universities, right? After high school, he attended NBA drafting, right? And then now he's one of the most successful NBA players. For Bill Gates, we also know that he didn't finish his university education, right? We would like to say that for some professional basketball players, the opportunity cost of working is greater than the opportunity cost of going to college. For the professional basketball players, they probably need to give up a lot of money and then experience, right? If they choose to go to school instead of accepting the offers they to play in NBA. Therefore, we would like to say when basketball players facing the decision of going to college or going to university or attend MBA, they also need to consider the opportunity cost. So for economists, would disagree with such statements that okay, education is good for. Well, we would like to say we won't say that everyone can benefit from a college education, but we will say the majority of us can benefit from college education because people have facing different opportunity costs of going to college, and this is a very important decisions in our life. Okay, now let's move on to the third principle, marginal thinking. Okay, so margin is a very typical economic concept. What does margin mean? Okay, so margin here means one more. Okay, either for do I need to eat one more slice of pizza? Do I eat one more burger or not? Or like, do I need to have one more hours of running, swimming, or sleeping? Or should I remain in school for one more term or not? Should I take another class in the summer or not? So you can see those involve the concept of one more, and one more in economics, we would like to say a fancy word like margin. People will also make decision at margin. Why? Let's see. To answer this question, okay, why people will make decisions at margin? we will need to consider the cost and benefits regarding to each decision, right? So we would like to say here, marginal cost, always abbreviated as MC, okay? So marginal cost regarding to the cost of additional units. And the next one, we would like to talk about marginal benefit, right? Marginal benefit will be MB, okay? So for marginal benefit, how people make decision. For the rational people, they will only make the decisions if and only if marginal benefit larger than marginal cost. Okay, so this is how people compare. When I face a decision, okay, first I need to figure out what's the marginal benefits of that decision. If it's greater than the marginal cost, then I will make a decision, right? If the marginal benefit is smaller than the marginal cost, then probably it's not a good decision, right? So this is also very important, okay? The rational people will only make one more or take one more unit if we have marginal benefit larger than marginal cost. So here the keyword is one more or like additional. Those are the keywords when we apply this important decision rule, okay? Either one more, additional, extra, okay? So those are some keyword when we apply this marginal thinking decision. So let's look at how we can apply this marginal thinking in one practice question. So this question, it says, okay, you are selling the car and you have already spent $1,000 on repairs. At the last minute, okay, unfortunately, the transmission of the car dies, okay? So you can pay $600 to have that transmission repaired, or just sell the car with the transmission die. So those are the two scenarios, okay? Or the two decisions. Either you can sell the car or is the transmission die. Or you can spend extra $600 or additional $600 to have the transmission repaired. In each of the following scenarios, should you have the transmission repaired or not? The first one, you can get your car quotation from a KBB, okay? And it tells you car for $6,500 if the transmission works, or $57,100 if it doesn't. So this is a one KBB quote. The second scenario, the KBB has another quotation for a car. $6,000 if your car's transmission repaired, or $5,500 if it doesn't. Okay, so in each of these two scenarios, you need to compare whether it's worthy or benefits for me to repair the transmission. Now let's look at scenario A. Okay. Can you first tell me if you decided to repair this transmission, what's the additional money you need to pay? According to this question, if you want to repair the transmission, the additional money that you need to pay will be $600, right? So we would say the marginal cost to repair the transmission is $600, right? So this is from the question. And then you can see if you have the transmission worked then you can sell the car for $6,500, right? If it doesn't, you can only sell a car for $5,700. So have the transmission worked actually can bring you the marginal benefit. That would be 6,700 subtract, sorry, it's not 67, it will be the 65, okay? 6,500 subtract 5,700, right? And this will be $800. So from here, you can see we have the marginal benefit of transmission repaired, $800. And the marginal cost of repairing transmission, $600. So we have marginal benefit larger than marginal cost. So in this scenario, will you repair your transmission or not? Yes, I will repair. Okay. Repair transmission. Okay. Repair is good. So repair is okay. Now, how about the second scenario? So for second scenario, we can say that marginal cost is still $600, right? But now the marginal benefit changes. So we have marginal benefit here. If have the transmission work, you can sell the car for $6,000. If it doesn't, you can only sell the car for 5,500. So finally, in scenario B, in the second scenario, we have the marginal benefit equal $500. And in this case, you notice now the marginal benefit actually smaller than marginal cost, right? Because the marginal cost is $600. Therefore, in the second scenario, we were not repair the transmission, okay? So this is how we solve for this type of the questions. Now, I think up to now we finished three principles, right? Or I would say three foundations. So let me just do a brief review, okay? So in our societies, we have a fundamental problem, right? The fundamental problem is we have limited resources. However, human beings always has unlimited wants. So this is why we will learn economics, because economics is the study of how people allocate their limited resources to satisfy their nearly unlimited wants, right? It is also the study of how people make decisions. And then we talk about the five foundations of economics we will learn in this chapter, right? The first one is life is about trade-offs. We said that all decisions involve trade-offs, right? We also talk about the opportunity cost. So there are several definitions of opportunity cost in this chapter, okay? We said the opportunity cost of any item is whatever you must give up to obtain the item, right? So this is the definition of opportunity cost in our textbook. There is another very popular definition of the opportunity cost. It says the opportunity cost is the next best alternative that must be sacrificed in order to get something else. Okay, so that could be an alternative definition of opportunity cost. And then in the third principle or the third foundations, we talk about how do rational economic agents to make decisions, right? So we said people first would list what decisions what options they might have, right? And then they would like to know for each options the opportunity cost. The rational economic agents, they always choose the options with the lowest opportunity cost. Okay, opportunity cost is a very, very important concept in this chapter. Okay, and it will we will not well we will also learn the opportunity cost in chapter 2 and chapter 3. Okay, so it is very important for you to know how to compute the opportunity cost and what the definition of the opportunity cost is. Okay, now let's look at another practice question about the opportunity cost. Ben is a two sport athlete, okay, who play both football and basketball. He can earn $1 million play either. Another person, Bill, okay, also play two sports. He could earn 1 million playing football or $200,000 playing racing car. Philip can also play two sports, okay? Still 1 million play football or $50,000 playing soccer. Now the question here is, assume all these three men, okay, have only two options to work and can only pursue one sport full time. Who will have the highest opportunity cost of playing football? Based on this scenario, if Ben chooses to play football, he need to give up playing baseball, right? Which means he need to give up $1 million play baseball. How about Bill? Bill need to give up $200,000 playing racing car if he decided to choose playing football, right? So for Philip, he need to give up $50,000 from soccer playing if he choose to play football, right? Therefore, who has the highest opportunity cost of playing football? Definitely, it will be Ben, right? Because he need to give up $1 million playing baseball. Okay. Now, the last principles that we just learned is about the marginal thinking, right? We compare with marginal benefit, marginal cost. So when we talk about margin, it has several keywords: extra, additional, one more. Okay, so those are the keywords for you to identify marginal cost or marginal benefit. So let's look at one more example. Jacob is planning to sell his house. He could sell his house now for $100,000, and he has an option by spending additional $15,000 to improve his kitchen. In that case, he can sell his house for $120,000. The question here is, should Jacob make a kitchen improvement before selling the house or not? So let's look at this question. As I just told you, there are several keywords to identify margin, right? In this question, we says, okay, he need to spend an additional $15,000 to make the kitchen improvement, right? So from here, we have the marginal cost will be $15,000 for kitchen improvement. Then we need to figure out if he improved the kitchen, what are the marginal benefits? We know that if he has the kitchen improvement, he can sell the house for $120,000, right? If not, he can only sell his house for $100,000. Therefore, we can have the marginal benefit of kitchen improvement will equal $20,000. So you can see, compare with marginal benefits and marginal cost. We have marginal benefit larger than marginal cost. So should he repair the kitchen? Yes, of course, because now we have more marginal benefits. Okay, so those are the three principles that we just learned. Okay, now let's just move on to the fourth foundation. So the fourth foundation will talk about incentives. Okay, What are the incentives? Can you think about some incentives now? So for incentives, we said incentives always work. Incentives are some factors, okay, that can encourage you to act or pay more efforts. People will respond to incentives, and incentives is very common in our daily life. So, for example, financial gains or like some actual credits, those are I can treat it as incentives. So there are some positive incentives, such as property tax increase can increase people's incentives to buy more housing, right? Or like the pay increase will encourage people to pay more efforts, work harder, or like the employee of the month award. So this type of award can also give the employees an honor, right? And then encourage employee to work better and harder. And then for my class, I offer you the actual credits, right? For watching the videos that I recorded. So that could be some positive incentives. So in our data, in my data, I have three kids, right? So my son, 10 years old, my little girl, 7 years old, and I have a baby, 1 year old. My son always try to be a nice helper because I give him some financial incentives, right? If you help me, yeah, you can get $1. So help me to watch the teachers, or maybe help me to take care of his baby, his sister. So those are some incentives, or we call it positive incentives. However, incentives sometimes will also bring some unintended consequences. The unintended consequences are some negative or unwanted consequences of an incentive. So, for example, we will talk about the social safety or the social security. The majority of people will agree that our societies needs those social securities or like what we call a social safety net because those are designed for the people who might get unemployed or have low income, okay, like the food stamp. However, what if the money from the safety net is higher than what you can earn from a job? So, for example, we have the unemployment insurance, right? We have the unemployment paycheck. If those unemployment insurance, or we call it unemployment benefits, higher than what you can earn from a job, do you think you were still motivated to find a job? Probably not, right? So those were some unintended consequences from the social safety net because it will have indirect incentive to encourage people not to work. All right. Then the last part, foundations, would like to talk about trade, international trade, or like personal trade. So those trade, we said trade can create value. So before we talk about trade, we need to know where the trade could happen. Trade what happens in markets. And markets is just a place, okay, bring about buyers and sellers together to exchange goods and services. Market could be physical market, like the farmer markets, like the grocery stores. Market could also be like an online trading platform. These days, I bet you bought a lot of things. You buy a lot of things online, right? Like Amazon or Walmart.com, Target.com. So those is also we can treat it as a market. And markets, we said market are usually a good way to allocate resources. Do you still remember in the first principle we said, okay, we have limited resources, but people have nearly unlimited wants, right? How to allocate those resources to satisfy people's wants? Market could be a good way to allocate resources. And there is a very famous sentences from Adam Smith's book, The Wealth of the Nation. This is a very thick book. In that book, he says, each of these households, firms, acting like guiding by an invisible hand to promote general economic well-being. Okay, so this is a very important statement from Adam Smith's book. People are guided by an invisible hand. By an invisible hand to promote the economic well-being. So this an invisible hand here regarding to referring to the price in the market. When price higher, we buy fewer products, right? When price lower, people buy more products. So we can see the price kind of like an invisible hand to guide the economic activities. And this has also happened in trade. So for the trade, it means the voluntary exchange of goods and services between two or more parties. So here the key word is voluntary. Why? Why you are involved in trade? People only involved in trade because trade can be benefits for them, right? So we would like to say, you don't engage in trade if it makes you worse off. Therefore, trade only occurs if both parties feel they gain from the trade. And that's just what we said from this foundation. Trade can create value. Okay? Why people involved in trade? Because trade can get them benefits. Okay. So up to now, I think I finished those five foundations of economics. And I think those five foundations are very important. You can also read several different principles from our textbook, but these five foundations are the most important foundations in economics, especially for opportunity cost. Okay, we will talk about opportunity cost in chapter 2 and chapter 3. Okay, so that's the end of our chapter 1. Thank you.